the channel. If you copy trading, you're an absolute moron and you're about to lose all your money. And with that out of the way, we're going to look today at a stock called Starbucks Corporation, very famous company, ticker SBUX. What these guys do, I think it's pretty obvious for most people. They run a chain of coffee restaurants. Some of them managed by them, some of them are licensed to individual operators. Now, I've been keeping track of this stock for quite some time. As you can see, the stock is down 20% year to date. And there are very good reasons for that because they had a pretty bad quarter uh, early in here. So we have a look at the earnings. You can see how they missed both in February and May. If we look at the EPS on an adjusted basis, is the same. And sales as well was pretty big miss. So you might be asking yourself, well, if this happened before, why didn't we enter this trade before? And the reason for that is, first of all, when we have a situation like this, it's typically the start of a downward trajectory for a stock like this. It is a 86 billion market cap company. But when we look at the relative basis, we see that the projections the company are starting to come down, as you see in these lines over here. And even though the share price is down quite a bit, 20% year to date, in reality, from a valuation standpoint, it hasn't really moved much since the start of the year. So we have at the moment, right, a situation where the company has been struggling for a number of consecutive quarters, but the valuation has not really compressed. It's gone from a high of 23 to just above 20, where it's sitting now. So that signals to me that there is still investors holding to the positions, or the market is propping up this underperforming company into a level that is arguably uh, high for the kind of performance that they're doing. So when we look at that, let's compare that to the rest of the sector, right? So you can see Starbucks is kind of middle of the road, but arguably there's room for this company to drop in multiples, say to 18, 16, 15 times if the next earnings, which are taking place at the end of July, don't pick up some steam. And I don't think that they will. I'll explain that a little bit later. So you got to bear in mind that Starbucks is a very has been a very well run company historically. They used to be growing very very fast on a consistent basis. And right now, the valuation is not much better than when they started. And companies that have historically not been so well run, or simply don't have the track record to support that valuation. And of course, it has a much lower multiple that companies that are very fast growing, like Chipotle or Wingstop. But what we're looking here really is a margin compression case as well. So I think the stock is getting into the perfect storm, and it's really going to get one last chance in the next earnings report to confirm whether their management actions are really going to turn around the company. If they don't, I think it's very likely that we see the multiple dropping down. But of course, like I said, there could be margin compression too. So let's have a look at the quants. So you see, first of all, if we compare this year to date, the sales have been stagnating, right? Gross profit margin is down. EBITDA margin is also deteriorating. Net income margin is deteriorating. And of course, so has the PE. And the market cap down by 30 billion, with cash being down, debt going up, and enterprise value also going down. Cash flow deteriorating and capex going up. So overall, not a great picture. Not terrible, but does it command a 20 times next 12-month PE? In this market, in this type of sector, I would I would argue not. So we see as well some commentary from analysts. So earnings being challenging, and the market um, had very harsh commentary about the latest earnings. So you see comps going down, especially in China, where the company has significant exposure, and that is a part of the world where I'm bearish too. The operating margins were down, and that's with a global store count that is up 6% year on year. So it's becoming more difficult and less profitable to run these locations that the company has all over the world. And that translates into this, right? So we can see in terms of KPIs, the comparable growth of sales, transactions, and average ticket being down significantly, but also really down on a quarter-to-quarter basis. Now, like I said, the market didn't really um, take this news that negatively, but I don't think they're gonna give many more chances to the company. And the reason for that is because we have unemployment rate in the US starting to take up. And that, of course, is going to affect the weakest segment of the population, which will inevitably hinder their profitability and sales. So overall, I think that we could see this stock going down to perhaps $60, maybe 65. That is not uh, really down from where we are. And the way I would be playing this is through put options. So at 70, we could retest that level potentially by the end of July and possibly to revisit the 2022 lows at 67. So how am I going to play this? Well, we see first of all that the upcoming quarters has um, a very unanimous and resounding negative outlook. And yes, that create consensus. That could create consensus for the stock. And if they actually go and beat, we could see a strong upside move. That is a possibility. But the interesting thing I find is that when you look at the analyst expectations and their estimates, most of the ratings from the analysts are from a buy to a hold. And yes, we are close to the lower band target, but I think there could be re-ratings down the line if the results do not pick up the company to the levels that it was expected at the beginning of the year. Now, one of the other reasons why I'm choosing to play this is because the volatility opportunity in this options stock is actually pretty damn good. Earnings are coming at the end of July, and we can short the August 16th 70 puts at 135 with a volatility of 37%. And that compares, there's some liquidity there, but that compares to the September, right? 70 puts at 176 with a 31% IV. Now, what is pretty good here to say is that our, because we're going to be playing with this as a spread, our credit, which is 135, how is that relative to our net spend, 176? We're getting 76% in the credit versus our net spend. Not bad. So the way I'm going to play that is with some puts, long September 70s and short August 70s on a 2-for-1 ratio. I get net spend and a 3.5 times return if we hit 60. Remember, this is by the August expiry, so it could take, I could restructure the trade after that expiry. But if we simply get to 70, which is not far off from where we currently are at 76, I still get 120% return. Not bad for my spend. So that's the way I'm going to play it. I'm going to probably enter this trade shortly. US labor is going to be struggling due to rising employment. ISM results have come up recently, and it seems that we're headed for another move down. And I think this will likely reflect in consumer discretionary stocks, especially the ones that are struggling, like Starbucks, and are having a bit of an existential crisis with the founder stepping in, making comments that are sort of echoing versus Bain consulting company that they brought in to bolster the company performance. And at the same time, we could see the market broadening coming to an end and starting to benefit all the sectors besides AI that are actually doing okay. But this one is not. This is not a company that is getting better, at least for now. So that's my idea for today. Hope you enjoyed it. See you soon.